Paul Tudor Jones, one of the best investors of all time, just came out saying that the market is about to crash and the stocks are very expensive. Well, if you don't know who Paul Tudor Jones is, he is a hedge fund manager, he is a billionaire, he is now 71 years old, so he has way more experience than me, but still, I disagree with him. And I think he's looking at the market with the boomer lens. I disagree with him. I disagree with the reasons why he says that the market is overpriced at the moment. And in this video, I'm going to break it down why I believe that the market is not overpriced or might be expensive relative to the past, but why I think that this doesn't reflect what the market is going to do. Because one thing that many people miss is that current market prices, stock market prices, they don't reflect the current market situation. Market is a machine that looks into the future, that looks into the future earnings and revenues of the companies, not really at the present. So the market involves a lot of expectations, and because of the current technological trends, there is also expectations that the market is going to grow. Okay, but let me share with you what Paul Tudor Jones said, and the best is you watch these few seconds, this clip of Paul Tudor Jones.
When I say leveraged, we're 252% of stock market cap to GDP. So 1929, we were, I think at the top we were 65%. And then in 87, we got to about 85 or 90%. In 2000, we got to 170%. And now we're at 252. So you can just imagine, if you think about the periodicity of significant bear markets, since 1970, we get kind of a mean reversion about, on average, every 10 years. When I say mean reversion, let's say mean revert to the past 25 or 30 year PE. So if we did that here, that would be, and again, these are elevated PEs, way elevated beyond the 20th century. That would be say a 30-35% decline. Well, 35% on 250% of GDP is 80-90% of GDP. The reverse wealth effect, oh my gosh. 10% of our tax revenues or capital gains, they go to zero.
Okay, so the first indicator that Paul Tudor Jones talks about is the stock market capitalization divided by the GDP of the United States. This is also called the Buffett Indicator. The Buffett Indicator basically divides the Wilshire 5000 by the GDP of the United States. And historically, maybe like, I don't know, 50 years ago, this could have been a good indicator, but it's no longer a good indicator. And let me share with you the screen so that you can take a look here at the chart. So as you can see, maybe since the 90s, this indicator has been overpriced compared to what used to be in the 70s and 80s. And of course now, at the moment, it's also very high. So the stock market capitalization to GDP is now almost at 200, all-time high. But why do I believe that this is no longer a good indicator? Well, the reason is that American companies, they don't depend that much on the American GDP. In fact, most of the S&P 500 companies sell to outside the United States. Check this chart here. On average, 41% of the revenue of the S&P 500 companies comes from abroad, comes from other countries. So there is really no correlation, and this indicator, the stock market capitalization to GDP, is not comparing apples to apples. It's comparing apples to oranges, because the revenue of these companies, again, the S&P 500 companies, comes mostly or in good part from international markets. And international markets is not GDP in the US, okay, so it's totally unrelated. In fact, the 10 biggest companies in the United States, over 60% of their revenue comes from international sales. So again, these companies are not dependent on the GDP of the United States. Probably this was true like 100 years ago. 100 years ago, we used to live in a less global world, and probably the sales of American companies would be really tied up with the American economy, but that's no longer true. Maybe if there was an indicator that is like something like American stock market capitalization divided by the entire world GDP, I think that will be a little bit more a reliable one, but not tied up to US GDP. Also, American companies, have big network effects, big efficiencies that allows them to be quite big. Let me just give you this example. At the moment, I'm in Thailand, right? And you go to the supermarket, and what you see? You see Coca-Cola, you see Pepsi, you see Procter & Gamble, you see Heinz, you see Johnson & Johnson, you see McDonald's. All these American companies are all over the world, and again, they are not, this is totally unrelated to the US GDP. Okay, the second argument from Paul Tudor Jones is that, again, the PE ratio of the stock market is too high. I have heard so many times people talking about the PE ratio, and the PE ratio, again, is no longer a reliable manner of looking at the stock market valuation. So the price to earnings ratio, because nowadays, again, earnings of companies are much different from they used to be 50 years ago, 100 years ago. Check this chart here that I'm sharing at the moment. You can see here that every time we have a technological disruption, a technological revolution, and we have the steam, the rail, the steel, electricity, chemicals, combustion engine, and then the petrochemicals, electronics, aviation, internet, software, computers, and now we have AI and robots and automation. And every time we have one of these big technological disruptions, the PE ratios of companies go up. And why do they go up? Well, I think we can see why. Because companies are now much more efficient, they can scale up much faster, they are less capital intensive. Imagine like 100 years ago, who are the biggest companies? The biggest companies are like manufacturing companies. You need to invest millions and millions of dollars in equipment, in factories, in supply chains. And nowadays, who are the biggest companies? Well, they are software companies, they are AI companies, they are computer chip companies. Much more scalable, much less capital intensive, and of course their earnings are larger, which demands a higher PE ratio, demands higher valuations. And they also much more like global companies when compared to 50 or 100 years ago. And in fact, I listed some of the reasons why, all the reasons why I believe that this PE ratio is no longer a good metric to evaluate companies. And if you are ever waiting, like Paul Tudor Jones said, for the PE ratio to go down to historical levels or to the moving average of the last 30, 35 years, you will wait forever. Paul Tudor Jones is a macro investor, but honestly, the best personality trait that you can have as an investor is skepticism, is don't believe in the experts, okay? Listen to them. I listen to everyone. I listen to Paul Tudor Jones. I listen carefully, but then you need to have your critical mind, because Paul Tudor Jones, maybe he's 71 years old. He doesn't know everything. Maybe you might have a better knowledge of the current market situations. And I believe that I can look at tech and AI in a little bit better manner. Okay, so here are the 8 reasons why I believe that the PE ratio is no longer a good metric for investors. Okay, number 1 is that the number of investors in the market is much larger. Retail now is participating in the market like never before. Everyone is buying stocks through their 401k. So there is just simply much more demand for stocks, and this pushes the prices higher. The second, much more importantly, is that technological innovations they are compounding, and better tech equals more efficiency, which equals lower costs for companies, higher earnings, and higher earnings equals higher PE ratios. It's as simple as that. There is no magic here. Technological innovations bring efficiency to companies, bring better margins to companies, and bring better earnings, and which means higher PE ratios. And that really doesn't mean that these companies are very, very expensive. You look at the PE ratios of like Tesla, Nvidia, Meta, Facebook, they're high, yeah, but they are high for a good reason. When you look at a company, there are 2 reasons why a PE ratio might be high. 1, might be overpriced, okay? 2, might B, because there is indeed good expectations that the company will grow. Which one is one? Like, we don't know, right? There are also two reasons why a company might have very low PE ratio. Is it low PE ratio because the stock is cheap? Or is it low PE ratio because no one wants to touch the stock because there is no prospects of growth in the future, okay? So I think we have a higher PE ratio in the market because there are high prospects of growth in the future. Okay, number 3. Every time we have a new innovation cycle, like I said before, PE ratios are pushed up, okay? And now we have AI, robotics, a ton of automation and so on. Number 4. The top 30 companies back then were industrial and oil companies. These companies, if you look at industrial companies, traditional like businesses that car industry and so on, Ford Motors and General Electric, they still have a low PE ratio. Okay, you look at the companies that used to be the top companies 30 or 40 years ago, and if you have the basket of those companies, their PE ratio is low. Now, the biggest companies in the world at the moment are tech, AI, software, and of course, yes, they have higher PE ratios for precisely this reason. Number 5, companies back then required lots of investment in tangible goods, right? In factories. Now, lots of intensive investment. Now, companies require much less investment in manufacturing, in factories, in equipment, and so on, which means that what investors invest in these companies have a higher return, okay? So, in which company do you think you'll have a higher return on the investment if you invest? Imagine if you are investing in a small manufacturing company that, I don't know, manufactures these little purses, okay? Versus someone who is investing in a company that develop a piece of software that can be sold all over the world like tomorrow. Okay, the second one has more potential for growth and more potential for earnings, okay? Number 6, stock buybacks. Back then, companies used to pay dividends. Now they prefer to do stock buybacks. It's a different way of distributing money to shareholders, is to buy back their stocks, okay, which will increase the stock price and consequently increase the PE ratios. Okay, this is also another reason. Then number 7, kind of already said this, but companies are now much more global and they are all over the world, right? You look at the 10 biggest American companies or the Max 7 or whatever, they are truly global companies. They are, again, not selling inside the US only. And finally, number 8, we are living in a low interest world, low interest rate. Back then, interest rates were very high, and these would have two different effects. If you are living in a moment like 40 years ago when the interest rates were super high, like 10% or more, well, one, people tend to leave their money in a bank or buy bonds because they pay you a lot. And number 2, loans to companies are also very expensive. Nowadays, interest rates are historically low over the last, I don't know, 10, 15 years or almost 20 years, right? Yeah, for 20 years they are very low. And this means what? People are less interested in leaving their money in a bank or in bonds, and they prefer to buy stocks. Again, brings the price of stocks to go up. Also, it's cheaper to borrow money, and this incentivizes consumption, which brings up earnings of companies. So yeah, these metrics, when you look at GDP, market capitalization to GDP and P ratio, take these metrics with a huge grain of salt, and also listen to the experts, but listen to them with a huge rock of salt in your hand, right? Because you cannot really blindly believe in these things, okay? And okay, there is a huge crash coming, yes, but if you are waiting for that crash to happen, maybe you need to miss the 100 or 200 or 300% upside that you could have in the market. So if you are waiting on the sidelines because stocks look expensive, well, they have been looking expensive for the last 10 years, and the market continues to go up. So I've been listening to these experts and people for the last 10 years predict the biggest market crash ever, and it never happens. And if you are waiting for it, you will miss the big gains. Of course, you had a few market corrections. You have it in 2020, 2022, 2025, even this year, like in March, right? But that big crash, no one can time it. No one has a crystal ball. And the best way to deal with it is just stay invested and don't panic. Don't try to time the market, because that's a loser's game. Anyway, I talk about this and much more in my community, in the Henrik Wealth Academy. I will leave the link to my academy in the description of the video. Take a look at it. And I'll see you next time. Give it a like and subscribe. And I'll see you soon.